Hey all, we have Mar here from Unslashed. He'll be doing a talk on risk management from traditional markets to DeFi. Just confirm you can hear him, and we are off to the races.
Hello, guys. Can you hear me? Hey, Jesus. Oh, cool. All right. So I'm going to start. So my name is Marwan. I'm the co-founder of Unslashed, which is an insurance protocol, and we are focusing on blockchain-related risks. We have been in stealth over the last months. We are starting to come out of stealth a little bit, and I'm happy to share with you some risk management wisdom today. So to give you a bit of background about myself, I'm more of a finance guy, built a couple businesses over the last years. I started focusing on proof of stake back in 2018 and decided there was something to do on staking derivatives early 2019. Then the staking derivatives led us to risk derivatives, and we ended up building Unslashed. And we discovered that the protocol we were building could actually allow us to insure any type of risk, like a general insurance protocol. So today we are going to discuss risk management. We are going to be focusing more on the instruments and the tools more than the processes of risk management. And we are going to see first the traditional markets aspects, and then see what is happening in DeFi, what we could use, etc., etc. So I'm going to share the screen with you totally and toggle myself here. All right. Can you see the slides? No one is answering. Okay. Yes, awesome. So we're going to start with a historic perspective. Basically, insurance, there was like early insurance-like products back in the day. And it started with cargo insurance in Babylon. So basically, caravan owners pledged their assets. If the goods they transported were not safely delivered, their assets were taken. And by assets, it was all their assets, including their families. Another example, which is basically the code of Hammurabi, that was covering the case of robbery. So if anyone was robbed and the person wasn't able to recover what was stolen, there was a kind of coverage where the amount or the assets that were stolen were going to be given back to the person. A third example, which is the Phoenicians, they applied the Babylonian principle to sea transport. So whenever there was a ship transporting anything, if it wasn't safely delivered, the ship owners ended up losing their own assets. So basically, they were depositing a kind of collateral, which was their own assets, and putting it to protect the risk of ending up with problems when delivering the different goods. And the third example is the fire insurance one. So in 1666, what happened in London is that there was a great fire, and this led to the formation of numerous insurance companies. So the early insurance companies that were formed were also owned by the early fire brigades at that time. So these are examples of early insurance-like products that existed back in the time, and that give us an idea that people were trying to somehow mitigate risk and manage risk with the tools that they had at that time. So we're going to start by discussing the philosophy of insurance. So the first point is that risk is everywhere, and risk is an uncertainty. So when talking about uncertainty, it's more a risk as a probability of or a chance of loss. So risk is based on a lack of knowledge. And if we know that a loss will happen, it means that we can act to prevent it. So on the other hand, we also have that the insurance is an attempt to quantify the likelihood and the severity of damage from an event if it occurs. So the idea is to say that insurance allows to spread the threat of loss over a large and diverse segment of the population. So if there is no risk, there is no insurance. And the idea is really to try to mitigate the risk by spreading it over a lot of people. Today, we have a certain number of risk management tools, and we need first to define what is risk management. So risk management is a set of financial or operational activities that maximize the value by reducing the costs associated with cash flow volatility. So in other words, this simply means that risk management is the action of minimizing the potential losses that result from identified risks. This is something that could be done either by using instruments or by using diversification. And diversification in this case is really a diversification of risk. And this mainly applies to big companies and large groups where assets are in tens or hundreds of billions, and where the activity is spread around the world with small exposure to each risk when taken individually. So this is the diversification, like a tool to do risk management. The other way of doing it is to use instruments, and we are going to take a look at the different instruments. So one way of doing it is through insurance. So there is the regular insurance that we know. There's also self-insurance, where a company or a person could put some money aside in order to provide insurance to oneself. There is self-protection, which is a different way of doing, which is basically to ensure or to put in place different processes in order to make sure that one is protected and to minimize the risk. And on the other hand, there are all the derivatives products and the structured products that exist in the financial markets. So these are like two sets of different instruments that are used for different types of risks. And talking about different types of risks, we can define categories in here. The first category is pure risk. The second one is operational risk. There is another category that is the pure risk and operational risk are not financial risks. So basically, it's insurable or not insurable risks. It's not necessarily exogenous in the presence of moral hazards, and it's a type of risk that cannot be controlled and mainly has two outcomes. So either it's a complete loss or no loss at all, and there are no opportunities for gain when we are talking about pure risk. There is no gain, there is no profit that is involved. So pure risk is generally prevalent in situations like natural disasters, fires, death, and these kinds of situations cannot really be predicted, and they are beyond anyone's control. So pure risk is also known as absolute risk. Operational risk, on the other hand, is more like employee errors, fraud, IT system breakdowns, etc. So this is also non-financial. This cannot be controlled, and this is something that could be prevented somehow, but an insurance is useful in order to cover it. So these two are non-financial. On the other hand, we have the speculative risk. And the speculative risk is basically the variation in prices of commodities, of exchange rates, of asset returns, etc., etc. So it's mainly related to the markets. It's mainly related to finance. And in between, we find liquidity risk and default risk. So default risk is the probability of default, recovery rate, the exposure to a default, etc. And the liquidity risk is the risk of not possessing or not having enough funds to meet short-term financial obligations. So without affecting prices, basically not being able to sell an asset at the right price when needed. And this might sometimes it degenerates into default risk. So for these kinds of for these different types of risks, we have a certain number of instruments that allow us to cover them. a first instrument is insurance. So we're going to start with definitions because it's pretty important. And I was pretty surprised to see people calling some types of products other types of products, and confusing the whole sets of instruments. So insurance is defined as a contract or a policy in which the insurer indemnifies another against losses from specific contingencies and or perils. So we have a lot of different examples. So we can think of car accidents, we can think of a house or a factory burning, we can think of an epidemic like the one we are facing right now, a natural catastrophe, and we can also think of more financial events, like we can have a debt insurance, we can have a bad debt insurance as well. So a debt insurance basically is, for example, when a person takes a loan, they are going to take an insurance that allows them to cover the possibility of a death event, serious accident or injury, loss of employment, etc., etc. A bad debt insurance is more like when a B2B company is supposed to receive payments for goods or services, and the customer doesn't pay, and the company ends up losing money. So this covers sets of events that happen in the real world that are not really related to the financial markets, and that are usually covered by insurance policies. Another product that is more financial markets oriented and that covers speculative risk is swaps. So swaps is a derivative contract through which two parties exchange the cash flows or liabilities from two different financial instruments. So there are a lot of different types of swaps in the markets. One type of swaps is the interest rate swap. So it allows to exchange variable interest rate for a fixed rate for a bond, for example, or for a loan. So if we take an example of an interest rate swap, it would be like a company that does not have access to a fixed rate loan. This company might borrow at a floating rate and enter into a swap to achieve a fixed rate. So, for example, if I have a rate that is going to be LIBOR plus 5% or something like this, I'm going to exchange it against something that is going to be more of a fixed rate. Also, don't hesitate to ask questions, because I'm going to pause in the middle of the presentation, try to answer some questions, and then go back. Another example is the currency swap, which is basically an exchange of interests and sometimes of principal as well in one currency for the same in another currency. So an example of a currency swap is a company that is doing business abroad. It might often use currency swaps to get more favorable loan rates in the local currency than if they borrowed money locally from a bank. So the idea is that you're going to have better rates in another country, so you're going to use currency swaps in order to have these better rates and use the funds to proceed in the local in this country. The third product is the futures and forwards. So futures basically are pretty simple products. So these are like agreements to buy or sell assets at a future date, and both have prices that are derived from some underlying assets. So, for example, there's this great example, which is oil. That's maybe some of you heard of. Basically, future contracts ended up having negative prices for oil. So this gives an idea of how it works. So you're entering an agreement where you're going to buy a certain amount of a certain quantity of barrels in the future at a fixed price. And the example that we have here is basically you're going to say that you'll be buying 1,000 barrels of oil from the seller at a price that they will pay for the futures contract. And at the expiry, the seller is going to sell the buyer the 1,000 barrels of oil at the agreed upon price. What happened with the futures price going negative is basically no one wanted to get to receive the oil, and people ended up paying for storage, and this drove the price in negative, which was pretty surprising and crazy. And the fourth product is options. So an options contract basically offers the buyer the opportunity to buy or sell, depending on the type of contract they hold, the underlying financial instrument. So it's an option. So there are lots of types of options. There are two categories, vanilla options and exotic options. So vanilla options are basically puts and calls. Either you want to be able to have the option to buy the asset at a certain price in the future, or you want to be able to sell it at a certain price in the future. There are also exotic options. There is chooser options, which basically gives you the possibility to wait for a certain amount of time before choosing the direction. Either you're going to be buying a put or buying a call. There are compound options that give you the possibility to buy other options in the future, I think, if I remember them well. And there are also binary options that have black or white results. So either you have zero or you get a certain amount depending on a certain number of events. So these options are usually used in structured products and in portfolio management. So when we think of these different instruments, they have different use cases. So for example, for the insurance products, it's used usually to cover pure risk, operational risk, sometimes liquidity and default risk, and it's never used to cover speculative risk. If we think of swaps, I saw someone writing credit default swaps. So credit default swaps are used to cover default risk or liquidity risk, and the swaps are mainly for speculative risk. Same for futures and forwards, same for options. And the difference, the conceptual difference between what is financial and what is not financial is basically to have insurable interests, meaning that you hold an asset, or you cannot stake or you cannot use the product unless you hold an asset that is going to suffer a loss. So this is very important. So you're not going to be able to buy an insurance for the house of a neighbor. You're going only to be able to buy an insurance for your own house or for your own car or for your own company. In the case of swaps, futures, options, you can use them as speculative instruments and take different positions no matter what you hold in your portfolio. And you can use them either to have some strategies or just to gamble somehow on the underlying assets. And the difference also appears in the way we price these different products. So in terms of pricing, we have insurance is based basically on statistical models, probabilities, and we need a lot of data. So one example is basically the mortality table for life insurance. The other example for swaps, the formula here is pretty simple, but there is a lot of math and calculation in order to have the value of a swap. But this is more like financial engineering and financial structuring. Futures and forwards, the pricing method is pretty straightforward. So it's the spot price multiplied by 1 plus the risk-free interest minus the income yield. And if we go back to the example that we talked about, which was oil what drove the price down was basically the cost of storage, which was a negative. And for options, we use Black-Scholes model, which is a pretty complex model that is based on the volatility, the strike price, the current price, and the time to maturity for the option. So there is a pretty important difference, and this separation also allows us to see how different products are used for different types of risks. So I'm going to stop here and take questions if there are any. All right. Yep. Okay. AIG credit default swapped by Karate Karadi. Well, yeah, the credit default swaps were actually pretty widely used at that time, and pretty badly used, actually. Futures insure operational risks. You can think of, I mean, it's a financial risk. If you're thinking about the price of a commodity or something like this, I don't know if you're referring to this mark, but it's more like a financial risk than a pure operational risk. Moral hazard. This one is very important. Moral hazard is important because basically, let's define it first. When someone is insured, they act, or when someone is not responsible for what they are doing, they might act recklessly. So this is very important, and this falls into pure risk. Wrong justice said, wrong usage of these tools disrupt reality for a long time. I think it's true. Basically, a lot of these products were used for speculation instead of using them for something more linked to the real economy. You sell a flight ticket. Mark is saying you sell a flight ticket for a fixed price at a date D, redeem it for D plus N. If price of fuel goes up, you have a downside risk, which you can protect against using futures. Exactly. Well, this is more like you're managing the finances or the treasury of the company. So it's more financial. If you think of it from it's not really an pure operational risk. How is Unslashed different than other insurance protocols? Well, we can discuss this in the end if you want. This was Al-Ost fun. Werner, what would you recommend as cheap hedge against variation of tokens price? A cheap hedge against variation of tokens price. Well, honestly, I would tend to sell. I mean, it depends on the tokens you're talking about. What are the tokens that you're trying to hedge? Exactly, that's the right question. Short-term or long-term hedge? You can use futures, definitely. Oh, nice. That's a nice question, actually. So Werner is asking a question regarding POS tokens, how to hedge their prices. Well, this is something that we had the opportunity to discuss, and it's very interesting. It's difficult to short POS tokens because there's so far there's no lending markets in order to be able to short them. However, the good news is that most crypto tokens are somehow correlated. So basically, you can try to find correlations between the POS tokens that you're trying to hedge and other tokens that have maybe more volume and that have more instruments in order to hedge them. And then you can try to have a strategy in order to be able to hedge and correct like every day, or have maybe a bot that will allow you to correct the position every day and to hedge the position. You cannot buy a straddle option on the token. I mean, it's not that easy to have straddle options, even on Bitcoin, even on Ethereum. I mean, the pricing of the tokens are way off most of the time, so it's not something that is that easy. Who sells these types of hedges? Option, put, call, exotic. Well, this is something that is sold usually. I mean, in the traditional finance, it is sold by investment banks. So they structure the products to fit your need, and their job afterwards is to hedge themselves. I mean, usually they hedge themselves, unless their name is Deutsche Bank, and they end up with a lot of problems afterwards. Okay, another question. I feel like POS token networks would want to incentivize staking over liquidity provisioning in lending markets. I agree, but there are a lot of things that are happening with POS tokens and POS networks. So, this is something that we'll probably see in the future. We'll see what's going to happen in the future. So Karate Kid is asking the question, who sells these types of hedges on crypto? Option, put, call, exotic. Put calls, basically you deal with OTC desks that allow you to have pricing for large quantities of options. And for exotic options, I'm not sure that anyone is doing them on crypto. I mean, there's not enough volume. There are a lot of, I mean, pricing problems with the volatility of crypto that makes it difficult to create products that are appealing in this case. Do you think new derivatives, Xavier Megan? Do you think new derivatives will be engineered in DeFi, not futures, swaps, options? Well, I'm curious, to be honest with you. I'm really curious, to be honest with you, because let me put it this way. I mean, finance is an industry that's existed for a long time. There are a lot of very smart people who are working there. So basically, from a traditional finance perspective, a lot of things that could be done were explored. So it's not like we are going to reinvent stuff. What I'm seeing right now is that in order to implement some of these products, the traditional finance products, we are already having a hard time implementing them in DeFi. So futures, I mean, it's something that is pretty straightforward, pretty easy. So it's already there. Swaps, there is Opium networks, I think, and swap rate that have a product that allows to do interest rate swaps. Options, there are a few protocols that are trying to do options, having a little difficulties in order to make something or to create something that makes the pricing fair or easy. J. Kim, I think there are also questions. Okay, so there are questions in Ask Questions. All right, Jesus, how competitive is ROE of insurance compared with lending or staking? It depends. It depends on what risk is insured. But in our case, we are looking at markets that could bring pretty interesting return on investment. What categories? Fred Blower, what categories do the current DeFi insurance projects fit into? Where does Unslashed fit? Well, this is something I think I'm going to be able to discuss in the next slide. So let's keep this question. If I don't answer it in the next slide, I'm going to get back to it. Is this ready for scale? By Lithium. I don't know exactly what you're talking about, Lithium. So what I'm going to do is that I'm going to go back to the slides, move forward, give you more information. If you have any questions, you can hit me directly in the chat. And at the end of the session, I'm going to go over the questions and try to answer as many as possible. All right, so we were in the pricing methods, and the question was about DeFi risks. All right, so in DeFi, we have a lot of different risks. So I'm listing some of them here. Most of DeFi risks fit into pure risk or operational risks, but they are more like hidden. So there is the Oracle failure risk. So for example, if an Oracle fails to provide the right data feed to an app, the users might end up losing money. There is the hacking risk, which is something pretty classic, either for exchanges, smart contracts, etc. The slashing risk, it's a pretty specific risk for POS. Basically, slashing is a punishment when a validator misbehaves in the network. The misbehavior could be an attempt to attack the network. It could also be something more like a human error. There is also the credit risk, which is more like for lending protocols, which is a little bit what happened with MakerDAO recently, where people ended up losing their assets in CDPs, which is a risk also that would happen with other lending protocols. If, for example, we had like another flash crash or something like this. So these risks are more like operational pure risks. The credit risks feeds more like into the default risk or the liquidity risk. And on the other hand, the speculative risks, we have all the losses that can happen due to prices going down. So this allows us like to have a separation between the two and to see where the DeFi risks fit. In terms of instruments that we have for risk management, so when we think of the swaps, the futures, the options, the forwards, etc., these are all derivative products. So for derivative, there are a lot of derivative protocols. So there is Synthetics, there is Market Protocol, there is UMA, there is Jarvis, Opium Network, and all of these protocols have one same objective, which is to allow users or to allow people to create derivative products. For futures and forwards, I was pretty surprised because basically I think that there is only FutureSwap that is doing it. Maybe I'm mistaken on this one, but yeah, which was actually in alpha not so long ago. For swaps, there is SwapRate, which is based on Opium Network. They offer interest rate swaps based on lending protocols. So basically, if you have a variable swaps on Aave, you're going to be able to a variable interest rate on Aave, you're going to be able to swap it to a fixed interest rate through their platform. And for options, there are a lot of attempts to do options. The first one was called Variable, which had a pretty great design, but the project ended up being stopped. I think it started in 2016 and was stopped in 2017. There is Hedgic, which was launched recently, and which had an interesting approach regarding the pricing mechanism for options. There is Open as well, which was launched not too long ago as well. And there is also Primitive that was launched like yesterday, and I had the opportunity to discuss with the guys behind, or the guy behind Primitive, and he is into something. It's very interesting. What he's doing is very interesting. So the issue with options is a pricing issue, which is pretty. I mean, no one figured that. No one was able like really to figure it out so far. So this is like for financial instruments. On the other hand, there is Ether Risk, which is an insurance protocol that has been around since 2016. I'm not sure if they are still active. There's also risk pooling through Nexus Mutual. So basically, it's a different type of product, not really an insurance. More like a mutual where people put all their risks together and accept what could happen afterwards. And what we are building is more like a hybrid insurance protocol. So this will allow me to move to something that will allow us to have or to set some basic concepts. So insurance requires models, and the models, in order to be able to have or to create insurance products, require data and time. So currently in this space, we don't have enough data, and we don't have, I mean, the whole space is pretty young, so we are not able like to really price insurance products. I'm talking about real insurance products as we should. So there is a very important distinction to make. Options are not insurance, and risk pooling is not insurance. And this image is an image of a cat, so it's not a dog. So this is very important, and it allows to see how things are. The approaches for the different products are really different, and so far we don't have like real insurance for DeFi or that allows risk management. So this is what we are trying to build. And one side effect of not having an insurance product, which is basically it's basically in crypto in general, not only DeFi, companies end up creating their own insurance companies in order to be able to offer a protection to their customers or to their users. So it can be like an official insurance company, like Gemini Exchange did, or it can be an insurance fund like what BitMEX has, or a SAFU fund like what Binance has. So everyone tries to have like their own insurance fund, because basically in the space there is no one who is going to, I mean, in the traditional insurance industry, there are not a lot of companies who are going to cover these kinds of risks. And in the DeFi space, there is no protocol who is going to allow to cover these risks. And another side effect of not having an insurance is obviously that the users are exposed to the risk of losing everything on one of the DeFi platforms. So the question was what we are building on Unslashed. Someone was asking this question. So what we are doing is a fully collateralized, transparent, and liquid protocol. So Unslashed is built on the Ethereum network, and we are leveraging the Melon Protocol for the asset management layer. So the protocol allows investors to underwrite risk in a very transparent manner, manage the assets that they are using as collateral, like investing, trading through DEXs, etc., while ensuring that the cover buyers are protected through full collateralization. So basically, our take on this is that we don't have enough data, so we need to fully collateralize the risk. And in order to fully collateralize the risk, people need to be able to use their assets. Otherwise, the cost of capital is going to be pretty high. And if we go back to the first slide we started with, there is another side to risk management, which is operational activities. So in terms of operational risk management, there are some protocols who are implementing processes who are disclosing the way that they are doing their internal risk management. So the first example is Avi. Basically, what they did is that they disclosed all their risk management processes. So they published this on their website. So they have a risk framework. They explain how they pick the different assets that they are going to integrate into the platform, the lending protocol. They also disclose their methodology. They show all the risk parameters, etc., etc. And this is very important for the users, for the end users. One first step is to have these kinds of disclosures, like to know what the protocols are doing, that they are taking into account the risks that are involved with the use of the platforms, to be able to somehow mitigate the risk, and also for us who are building an insurance protocol to know what is being done by who and what is implemented at each level. Another example is MakerDAO. So back in, I think, 2018, they published one section about risk management. They didn't disclose much, to be honest. So I don't know if there are any other reports in other places. I know that they have a risk management team. They have risk management or risk management calls pretty regularly. And the idea is that they also take into account the risks involved with the assets that are used as a collateral in MakerDAO as a protocol. And the third example, which one that is pretty interesting, is Melon Protocol. So Melon Protocol is an asset management protocol, and it allows, when one is creating a fund, it allows to configure the risk management profile of the fund. So it allows to pick the price tolerance, the maximum number of positions, the maximum concentration for one asset, to whitelist some assets, etc., etc., and to blacklist also some assets. And the great news is that one can build also their own risk management rules by adding modules to the protocol. So it's pretty open, and this is actually what we are. This flexibility is what we are going to leverage on Unslashed, and we are going to build our own risk management layer on top of Melon Protocol. And finally, one project that is doing a great job, which is a kind of beginnings of a rating agency, is DeFi Score. Yeah. So what they are doing is basically they are taking a certain number of criteria, and they are rating the different DeFi platforms based on these criteria. And this allows us to have like one screen where we can see the score, which is a pretty simple score, easy to comprehend, and then go into the details, see the methodology, etc., etc. So this is something that I'm pretty happy to see happening, and that we should encourage, because this for me, or in my point of view, this is like the first step. Maybe it's not decentralized. Maybe they will find ways to decentralize the DeFi Score in the future. But the way it is built right now, it's something that is very important for the space, and it helps a lot. So if you're interested, in discussing risk, insurance, or whatever, you can ping me on Telegram or send me an email. You can also follow us on Twitter. And now I'm going to go back to the Q&As. All right. So, John. can we use your insurance now? And if not, when? If you're interested, we are going to start testing. We are going to have a version on the testnet in about 4 weeks. So if you want to be part of the first people using our insurance, you can ping me. I'll be happy to show you what we are doing and to get your feedback. Any other questions? Okay. Al, can you explain again how it works without a debt pool? Can you explain what you mean, how it works, what works without a debt pool? Are you talking about Maker? Are you talking about something else? Fred, excellent presentation. Thank you, Fred. Oh, Unslashed. We don't use a debt pool, actually. We use collateral. All right, got it. Al, Unslashed works basically by fully collateralizing the risk. So there is not a debt pool. There is collateralization. Mark, by being fully collateralized. I don't understand what you mean by being full. You answered. Okay, all right. You answered all. Okay, right, great. You got it. That's the right answer. Xavier, why did you move from staking derivatives to insurance? Well, actually, we were on risk derivatives. And the risk derivatives basically were leading us to building an insurance product for proof of stake networks and for slashing. And then while building it, we were like, okay, we are building this thing, and actually we can cover any risk with it, because we ended up building a full general insurance protocol to fit one type of risk, but we can fit any type of risk within it. So we decided, okay, there is an opportunity to really provide an insurance for proof of stake risks, for DeFi risks, for any other types of risks. So let's do it.
All right, cool. So if we're done with questions, we can just take a short break before we go to the next session. Or if you have any additional questions, ask them now. There we go.
All right. So Cool is asking, what risks is Unslashed insuring on launch? We're going to have a pretty large set of risks from launch, because basically we got a lot of people interested, but we are going to have both the POS risks and the DeFi risks at the same time. John, does a fund manager use, or can a fund manager use your product on Melon Port? Not directly on Melon Port, but basically you're going to be able to use our product. You're going to be able to use Melon Port through our product. So we're building on top of it. Al, can you give a few more concrete examples of how insurance works on Unslashed? Okay, let me give you an example, pretty simple example. you want to you want to ensure yourself against the slashing risk of a validator on Cosmos Hub, for example. All right, so you have some atoms, you're staking them. There is this slashing risk. You want to have a cover. You're going to go to come to Unslashed, and you're going to say, okay, I want to buy this amount of cover. You enter the number, you make the transaction, and you get a token that represents the insurance. On the other hand, in order for you to be able to do this, someone else needs to collateralize the risk. So someone else is depositing a collateral that allows you to have the cover. All right. If there is a slashing event that happens, basically the funds are transmitted to you. Al, does it make sense? Al, okay, and that someone else is found how? There are going to be other people who want to take on the risk. It's not a debt pool. A debt pool is basically what is used in lending protocols. That's why it's called debt. So it's a collateral pool, if you want to call it a pool. But what we are doing is that we are allowing anyone to collateralize the risk that they want to collateralize. So the approach is different from just putting everything in one pool. Cool. How is premium payments allocated? And how is Unslashed monetizing? Honestly, we're not looking to monetize in the beginning. We are starting, so the idea is more to have people using the protocol than anything else. The premium payments are allocated directly to the people who are collateralizing the risk. So if you deposit collateral for a specific risk and someone buys a cover, you're going to receive the premiums. Where does the collateral come from? The collateral comes from people who want to collateralize risk and earn a yield, because earning a yield is great, and it gives the opportunity to have a risk that is non-correlated to other risks in the market. So, for example, you can have a portfolio of, I don't know, of funds that is on Compound, on Avi, etc., and you can at the same time collateralize the risk on Unslashed. And this allows you to have a diversified portfolio of risks. So basically, anyone can put the collateral. That's the main point. Cool. Are the premium payments competitive with other DeFi products, lending markets? Yes, they will be. Al, makes sense. Thanks. Well, thank you for the questions. Actually, cool. To be fully transparent with you, it's going to be more competitive than lending markets because the risk is higher. Great presentation, Anna J. Thank you, Anna. Kevin, are the slides available anywhere? Ping me. You have my Telegram handle. You can ping me, and I can send you the slides.
All right, guys. So since I think all the questions are done, we're going to start our next session early. If you guys have any last questions, feel free to reach out to Mara on Twitter.
All right, cool. Thank you, Shinju.
All right, thank you.